Welcome to Ironwood Wealth Management's Market Insight webinar for the fourth quarter of 2015. My name is Nick Basso, and I'm a Portfolio Administrator in Ironwood's Investment Division. Tonight, it is my pleasure to introduce our featured presenter, the Chief Investment Officer here at Ironwood, Mr. Sean Rogers. Sean is a charter holder of the Financial Analyst designation, and he also serves as Ironwood's primary investment strategist. If anyone has questions for Sean during the presentation, feel free to type them into the chat box that is attached to the GoToWebinar panel on your screen. We will do our best to address all questions and comments at the end of the presentation. And now, without further delay, please join me in welcoming Sean to lead this evening's presentation. Sean, take it away.
Thanks, Nick. Good evening, everyone. Welcome to another edition of the Ironwood Quarterly Insight Call. I'm glad that everyone could join us tonight on this call. The last time I talked with you guys was early August, and a lot has happened since August through the markets, and a little bit less when we look at what economic impacts have actually happened. But there's been some significant moves in a lot of the equity markets. So we're going to talk a lot about that. When I first started preparing my presentation, I prepared these at the end of the quarter and put it together over a 2-week period of time. We were in a lot different period of time when I first put this together. So I've updated some of the slides to reflect more recent data. But leave it here on the disclosures for a second. The topics that I really want to cover today are China. That's one of the topics that's on the forefront, and the economic slowdown that we saw in the summer. Always on the forefront is what is the Fed doing and when they are going to do it. We want to talk about 2015 returns. We want to talk about 2016 outlook. And then, as always, how does that impact our investments in the future? So the third quarter, if we look, this slide, I kept it in here. It just goes through the third quarter. So this is before October. This goes through September 30th. So if we look at how the equity markets performed year to date through September 30th, we would have seen that the S&P 500 was actually down 5.3% for the year. Developed International was down just a little bit less, 4.9%. Emerging markets were down a lot more than both of those other two, down 15.2%. The 10-year Treasury fell from 2.35% to 2.06%. ISM data was very mixed during the quarter, July, August, and September. And then the U.S. job market improved, but at a much slower pace than it had been improving in. That's kind of what we saw through September 30th. October was a much different picture. And so if we look here, when I was preparing these slides, we were going to talk about how the U.S. economy was maybe a little undervalued, or the S&P 500 was a little undervalued. We had a dividend yield of 2.5%, which is pretty good. We had a PE multiple of 15, market level at 19.20. This was, literally 1 month ago. And oh, how a month can make a difference. So here's more updated. This is through October 31st. October was the best month since 2011. China data improved. Europe data improved. ISM non-manufacturing in the U.S. came in very strong for October. The S&P 500 was up over 8% in October. So we have a much different picture. In fact, the last time I talked with you guys in early August, we were at these levels, and we were talking about being a little cautious on domestic stocks. And so you're going to hear a lot of the same things that you heard last time I spoke, but a lot has happened between the times, so I do want to kind of go through that a little bit. But a lot of what we had said 3 months ago is still going to apply at these elevated levels. Internationally, the market recovery wasn't as good, and still international markets, developed international markets, are still below their 2007 highs, so that's still the case. Dividend yield at 3.1%. These are numbers through October 31st. So that's a great dividend yield compared to where we're at in the U.S., where as of today we're at about 2.1%. So here's the story we were going to tell of an undervalued U.S. market. Some of the valuation metrics that we look at: price to earnings, the Shiller PE, dividend yield, price to book, price to cash flow, earnings yield spread. Those were all undervalued 30 days ago, 35 days ago, let's call it. Now, with the recent stock market increase, especially here domestically, we get a little bit of a mixed picture. None of these metrics, if you look at standard deviations away from their norms, none of them are too far away from their norms, with the exception of maybe the price to book you can make an argument for, and then the earnings yield spread. And so the earnings yield spread tells us that either the stock market is undervalued at these levels, or maybe the fixed income market is overvalued at these levels, or some combination of both. But I think if you look at all 6 of these metrics together, you kind of get an idea that the S&P 500 at least is pretty fairly valued. You could make an argument that in a low interest rate environment, some of these valuation metrics could probably get a little higher in this type of environment. But for the most part, I look at these and I make the assessment that the S&P 500 is probably pretty fairly valued at these levels. Now, with that said, one of the things that we take a look at is the real earnings yield. And if we look at previous bull market cycles and we look at where the average valuation is, where that fairly valued level is, in the past several bull markets here, we're looking at average valuation when the real earnings yield gets to 2.5%. So the real earnings yield is just the PE multiple of the S&P 500 flipped upside down, and then you take out inflation, and that's how you get the real earnings yield. And so it's been coming down, but it's not even at 2.5%. And what this chart here on the right shows is that in these past bull markets, so for instance, in 1966, we had a bull market. The market went up 29% before the real earnings yield got to 2.5%, and then after that it went up an additional 15%. So in every single one of these, with the exception of the 2002 bull market, we hit 2.5% real earnings yield, and then we continued further. And the only reason I bring this up is even though our assessment of the S&P 500 is that it's getting closer to fairly valued, doesn't mean that the bull market is going to necessarily end. It is very difficult to forecast when bull markets are going to end. Even though the S&P 500 in our estimation is fairly valued, things typically go from one pendulum to the other, and that's exactly what this graph shows. It's just showing typically we go past that average valuation, and in some cases we go well extended, 83% past it, 49% past it, 30% past it. The key takeaway here is that we still have about 15-20% on the S&P 500 with the current inflation to get to the real earnings yield of 2.5%. So not necessarily over for the bull market, but at these levels, we want to be on the more cautious side. So now, what do the returns look? I already mentioned what the returns were through the third quarter, but if we had October, where we had just a stellar month for a lot of equities, we get these year-to-date numbers. You can see large cap domestic up 2.7%, developed markets, international 2.5%, real estate investment trusts up 1.7%, fixed income up 1%, high yield up 1%, cash flat, asset allocation portfolio flat, small caps down 2.5%, emerging markets down 9%, commodities down 16%. So we've got quite the array of returns depending on what part of the market you're looking at. U.S. economy, it slowed down in the third quarter. Second quarter GDP growth was 3.9%. Third quarter GDP came in at actually 1.5%. However, there was a significant inventory drag in those numbers. And if you've been on past calls, we've mentioned this inventory drag in the past and how we did think that was going to be a headwind. The inventory levels did not go up this time around. In fact, they came down a little bit, which means that some of that drag that we saw going forward, we actually saw it. So going forward, it won't be as much of a drag on GDP growth. Another point I would like to make on this chart is just the average speed of the U.S. economy. We're not going to see the days of 4% GDP growth on a regular basis. Post 1985, we saw a big shift in demographics, and the working force just hasn't been growing as fast, shown right here. And so we were growing, well above 1% in the 60s and 70s, almost 2%, 1.5% through 84, and then in 85 we dropped off. And really, GDP growth, we can boil it down to growth in workers and growth in real output per worker, which another word for that is productivity. So growth in the labor force plus productivity growth will equal our GDP growth. And you can see 2005 to 2014, we've had a significant decrease in both of those. The growth in the working age population, there's going to be, this number is not going to be going up very much in the future. If you look at demographics, there are numerous people turning 65 every day and leaving the workforce, not joining the workforce. So we have a huge demographic issue with growth in the working age population, and that's going to continue to hamper how fast the U.S. economy can go. Now, that doesn't mean that the stock market can't produce returns. It just means that GDP growth will probably be a lot less than what we've seen it in the past. Cyclical sectors, they actually looked pretty positive. We had a couple of choppy numbers in the summer, but I mean, if you look at autos, 18.1 million units, housing, very positive trend since the recession, and even a pickup more recently. Real capital goods orders, we had a little bit of a negative trend there. Now it looks like we're turning a little bit, but we're still above average levels. And then inventories. We were worried about inventories. They kind of spiked up here, but they've come down a little bit. We still have a little bit of headwind in front of us because inventories are a little bit elevated at these levels, but not as much as they were a few months ago. These are August numbers here. So if we look at September, we're actually down from here, and that was part of that GDP headwind that we saw during the third quarter. So we'll continue to see these go down a little bit near term. Unemployment. A little mixed picture here. This can be a deceiving graph here. Since the recession, we had a max unemployment level of 10%. We've come down to 5.1 in a very quick period of time. Most economists probably would not have predicted we would get to 5.1% so quickly. Tomorrow there's a jobs report coming out. It'll be interesting to see that because I think it has a lot to do with, right, I think what we see in the jobs market tomorrow will either solidify a Fed increase in December or postpone it. I think it has a lot to do with what numbers come out tomorrow. But back to my original thought here, 5.1 is a little deceiving because we have participation rates at multi-decade lows. The participation rate is at 62.4%, a level we really have not seen over 4 decades. So this can be misleading. Although the job market is healthy, it might not be as strong as a 5.1% unemployment rate. I think a true indicator of a healthy jobs market would be to see the growth in wages above 2%. So right now we're at 1.9%, off of lower levels that we saw earlier this year, but definitely not as high as we were a few years ago. So we'd like to see this wage growth a little bit higher to give us the all clear as far as it goes with the labor markets. The participation rate, like I said, multi-decade lows. This chart only goes to 90, but you can see, 62.4%. This is a long-term demographic structural issue here. The participation rate is not going to be coming up significantly. There are too many people turning 65, hitting Medicare and Social Security age, and leaving the workforce to retire. And as long as we see that, you're going to see different trends than maybe we're used to because of the contraction in labor force. So that's something that we definitely want to keep an eye on, and that's one of the reasons that 5.1% doesn't really, it is a little misleading. We have created 13.2 million jobs since the recession. We lost 8.8, so a net of 4.4 million jobs. A lot of those jobs that we created are actually in better paying areas of the economy. You can see with this chart here, financial and business services, information, manufacturing and trade. So those are higher paying jobs than maybe some of the leisure and hospitality and educational jobs. Inflation. This is one of the reasons that the Fed is not in a hurry to raise interest rates. Inflation is definitely at lower levels. Core inflation is showing 1.8%. Headline is 0.2%, mostly due to energy prices. The Fed is not going to be worried about raising rates because of inflation anytime soon. Now that can change pretty quickly, but right now, with a core inflation of 1.8 and a headline at 0.2, not really making the case for a rate hike or multiple rate hikes at this point. But that's definitely going to be the driver for future interest rate moves. Which brings us to interest rates and the Fed and monetary policy. So the 10-year Treasury, like I said before, was 2.35%. At the end of October, it was at 2.16. It's actually closer to 2.25 now. We do anticipate, it's our thoughts that the Fed is going to increase interest rates in December. Janet Yellen came out and gave some insight on that yesterday. Another Fed governor today came out with some statement that kind of backed that up. So tomorrow should be a key indicator. If we see a jobs number that's just kind of average, say 120,000 or 140,000 new jobs created or more, I think the Fed is going to lift off in December. Expectations. So the Fed and the market, and what are each of their expectations? This blue line here shows where the Fed thinks the Fed funds rate will be at different periods of time, and you can see the Fed as a collective group thinks that the short-term Fed funds rate is going to be at 0.38%. Right now it's at 0. So unless they hike 38 basis points, most likely they're going to probably do a quarter or possibly, half of that, depending on what they see and what we get tomorrow. But a collective group, they see it a lot higher than what the market sees. And if we just go out a couple of years, the market is looking at 0.77, whereas the Fed as a collective group is at 1.38, and then we've got some significant gaps between what the Fed thinks is going to happen and what the market thinks is going to happen. So there's some mispricing here if we look at what the market's expecting versus what the Fed is expecting. Why do we care about that so much? Well, it's going to dictate moves in the yield curve. Over the past year, we can see what's happened to the yield curve. The September 2014 yield curve is in gray here, and the September 2015 yield curve is in blue. And so you can see that basically rates have lowered and flattened. The yield curve has flattened a little bit, not a lot, but a little bit, and most of the yields have come down. So 30 basis points, 40 basis points, 40 basis points. So we've seen a downshift, but then in the short term, we've seen actually an increase. And so this is starting to flatten that yield curve. Now, there's only 3 here, but in the last 5 rate hike cycles, say that 5 times fast, in the last 5 rate hike cycles, we've seen the yield curve flatten tremendously in each one of those 5 instances. And we just see 3 of them here, but you see short-term rates increase a lot more than long-term rates. We definitely want to make sure that we know what's happening with the yield curve. It's very important because it has a lot of impact on our fixed income and where we want to be in our fixed income portfolio. Now, it's our belief that bonds are a little bit overvalued at these levels. Interest rates are very low. They've been very low for a long time. We do believe that interest rates are headed north, and we want to make sure that we're very careful on the fixed income that we own. Now, with that said, fixed income is also one of the only asset classes that is negatively correlated to equities. And so that is a very important piece to any portfolio. So we don't want to abandon fixed income altogether. We just may want to be very careful at what fixed income we own. And so let's go back to our yield curve flattening and interest rates going up. Well, if we own 2-year treasuries or 5-year treasuries, we're going to be a lot less impacted. This is showing you the price impact of your bond if interest rates increase by 1% or fall by 1%. So for instance, if we owned a 2-year treasury, let's say we bought it for $100,000, if interest rates increased by 1%, your $100,000 would now be worth about $98,000. So it's going to lose 2%, which isn't that big of a deal. But if you had that same $100,000 in a 30-year treasury and interest rates went up by 1%, your $100,000 is now going to be worth $82,000. So you might be a little bit more impacted with an 18% decrease versus a 2% decrease. Now you're going to get paid a little bit higher interest rate down here, but we do not believe that getting paid a little bit higher interest rate. So as of 9/30, the yield of the 30-year Treasury was 2.87%. So you're getting paid, call it 2% more than a 2-year Treasury, but you're taking a lot more risk if rates go up. So that's one of the things that we want to be very careful about, is where, what we're owning in the bond portfolio. And then taking this a little bit further, if we just don't look at Treasuries, but we look at floating rate, convertibles, and so on, you can see the different impacts. We right now have a higher credit risk and lower interest rate risk in our fixed income portfolio. That's kind of how we've been positioned over the last month or so with the higher credit. Before yields blew out, we were actually pretty safe, lower on credit and lower on duration. Duration just meaning when the bonds are going to mature. So we've liked the 2 to 4 year period for a while, and before rates blew out here in September and August, we actually liked it a little safer. Which brings me to my next point here. About a year ago, actually a little over a year ago, August of 2014, we made a pretty dramatic shift in our portfolio. We lightened our high yield mix because the spread between, let's say, a 10-year high yield bond and a 10-year Treasury, the yield spread between those two tightened all the way to about 4.5%, which is extremely low in the high yield space, considering the average spread is about almost 6. Well, just recently in the third quarter, high yield actually lost 5% of its value because yields blew out. A lot of this had to do with energy. About 20% of the high yield market is energy companies, and with oil at below $50 a barrel, people are probably pricing in higher defaults in some of those areas, and so the whole high yield space kind of took it on the chin a little bit. We saw this yield spread as high as 7.1. When we rebalanced the portfolio in late August, we actually added some exposure to our higher yield bonds when we did that rebalance, and it's paid off tremendously for us over the last month and a half or so. If the Fed starts to increase interest rates and interest rates start to increase, what kind of impact will that have on our stocks? That's the reason I've added this slide here, interest rates and equities. This just shows you the relationship between an increase in interest rates and how the stock market reacts. And so as long as we're below 5% for the 10-year Treasury, which right now we're at 2.2, call it, as long as we're below 5%, increases in interest rates are actually positive with the stock market. So as interest rates go from 2.2 to 3.2 to 4.2, the stock market generally has a positive correlation with those movements. As soon as we get to 5%, you can clearly see that we have a downshift in correlation coefficient here, which means as interest rates go from 5 to 6 to 7, it is actually negative to stock returns. So in the short run, when interest rates are low, as they go up, we believe that we'll continue to see this. It'll mean that, okay, the Fed is raising rates. They believe the economy is doing well. We're going to start to see some wage growth. The economy will start to hum a little bit. That's why we still think that this bull market has some legs. PE multiples and 5-year realized returns. So this chart just shows that if we look at the forward PE and we use it as a predictor of what we're going to return for the next 5 years, we can see that these have a pretty good relationship. I mean, it breaks down every once in a while, but there is a positive relationship with where PE multiples are and the next 5 years return. And so you can see this is 5 years back because it's always 5 years back. But what it's predicting, and these numbers are a little bit misleading because these are as of September 30th. It basically would be predicting that the next 5 years, if this trend follows, that the S&P 500 would return about 9.9% over the next 5 years. Now, we recalculated this. It's more like 8% with where stock levels are right now, with where the S&P 500 is on a PE multiple right now. So just insert 8 here where 9.9 is. But you can see the relationship of the expected returns of the S&P based on forward PE. If the Fed does raise, what can we expect from the S&P 500 historically, and what can we expect from the fixed income market? So you can see here, these are the last 3 rate hike cycles. And when the Fed starts to hike, we see that equities usually have a knee-jerk reaction that is negative initially, and then they do very well in the subsequent months. Whereas fixed income tends to, the yield tends to increase very quickly and goes almost to where the Fed ends up being at the end, but it does it within months. So you can see here, they start to hike and the 10-year Treasury spikes up, 2.5%. And then it goes up again later. Goes up initially and then comes down. Goes up initially and then comes down once the Fed is done with their rate hike cycle. Same thing here. It was quicker, and then we kind of had a dip, but you end up higher until they stop raising, and then rates come down. So we believe that if these trends continue, when the Fed does decide to hike, if that's in December, the market's going to be very choppy. The S&P 500 is going to be very choppy at first. The 10-year Treasury, we believe, goes up very quickly. And so that is one of the reasons that we're very bearish on fixed income, is we want to see this first rate hike and see how the fixed income market reacts. Not as worried with the stock market. There's not a lot of movement there, and we know over the longer term it usually points to a higher stock market months down the road. But this is what's happened over the last 3 rate hike cycles. So it's very important because we could be in this scenario here come December. So we wanted to point this out. International markets this year have not done as well as the S&P 500. However, if you start to look at some of the reasons why, you can see clearly at a glance what's happening here. So we've got the S&P 500 up 2.7%. If we looked at developed international and we looked at its value in its own local currency, we'd be very happy with 7.3% return from our international holdings in their local currencies. But then when we translate those back to US dollars, we lose almost, we're losing almost 5% there. Europe, ex-UK, we're losing even more. Emerging markets, only down 1.8 in local currencies. But when we translate it back to US dollar, down 9.2. So the big driver of the performance of some of our international holdings and why they're a drag on the portfolio versus the S&P 500 is the currency translation. It's the strong dollar. Now, as much as that's been a negative over the last, call it 18 months, going forward, that's going to be a positive for some of these countries that will now become a lot more competitive with their exports. Another item I wanted to point out on this particular slide is that we do get a huge benefit from owning international and emerging markets inside the portfolio. If you look here, you can see the correlation, and during the stressful time of 2008, correlations were very high, close to 0.8. They've since dropped back to more normal levels, where now stocks that are international or emerging market compared with the S&P 500 are correlated at a much lower level. And when you add an asset that is lowly correlated into a portfolio, you reduce risk without necessarily giving up return. And so it makes it as a very powerful portfolio tool to add asset classes that have low correlation. The Eurozone actually looks very positive, headed in the right direction. We've got some positive trends here. On that same note from the last slide, US dollar per euro, we've gone from $1.39. As of today, we're at about $1.09. So that's going to be a positive. It's definitely hurt European stock returns, but going forward, it's going to help companies that export outside of Europe. Both market PMI and GDP growth are positive and going in the right direction. Credit demand is going in the right direction. Unemployment is still high, 11% in July, but it has a lot of room for improvement. It's kind of like where the U.S. was back in, let's say, 2011. Both Europe and Japan look a lot like the U.S. in 2011. We've got, you got QE going on. You've got high unemployment. You've got stimulus, and that ended up being pretty good if you were an investor of U.S. stocks in 2011, and you look back until now. You're probably pretty happy about that decision. So we do like Europe. We do like international developed, and we do like emerging markets. With emerging markets comes volatility, which is exactly what we saw this summer. China, you can see their GDP growth has slowed over the last few years. If you believe the People's Bank of China's numbers here, we're looking at Q1 of 2015 at 7%. Most economists think that's, closer, let's say, 5 or 6%. So they're definitely slowing, but that's normal for an emerging economy that is bringing just an extraordinary amount of people from poverty to the middle class, and that you're gonna start to see that. It'd be hard to doubt China because they're also sitting on $3.6 trillion of foreign exchange reserves. So if they want to increase growth, they have the means to do so. And that's these are one of the reasons that we're very positive on emerging markets, in particular China, but also because of the cyclical sectors and the improvement. And so one of the drivers of the 12% pullback on the S&P 500 and other indices, developed emerging markets, small cap, this summer, China slowed down pretty quickly, and market participants started to forecast or started to try and figure out what the probability of a global recession was. Because if we have a global recession, then all aggressive assets are going to be impacted by a global recession. And so markets, they price these things in very quickly. And that's exactly what you saw this summer with China. But since then, you can see even though since the recession, since 2011, the last 4 years, China's gone from 14 million units for auto sales all the way to 20.3. And yeah, we had a dip here in the summer, but we've improved since then. October services, so we've got the manufacturing October numbers, but we were stuck with the September 2015 services number. The October services PMI number, it would hit 52. So that also is going in the right direction. Anything over 50 means they're growing. China is changing from a manufacturing-based economy to a services-based economy, just like the U.S. did. And you're starting to see this throughout their data. Construction of private residential flooring space spiked in September. You've got a lot of positive things, and this was a trigger not only for the slowdown in the summer months, but also a trigger in the opposite direction for the rebound in many areas, you know, whether it be emerging markets, S&P 500, small caps. The probability of a global recession, because China is now looking a little bit healthier, dropped that much, and market participants priced that in. One of the things I wanted to point out on this slide, China consumes a lot of industrial metals. And in fact, as a percentage of the world consumption, they're almost half of nickel, zinc, and aluminum. They are half of copper, and they're more than half of iron ore. So if we see a slowdown in China, these industrialized metals are going to have pressure on them. And that's exactly what we've seen in correspondence with the slowdown in China. And since, you know, oil and some of these other commodities hit lows a couple of months ago, and now they're off of those extreme lows, they're still very they're still off of levels that we've seen, and they're still down for about 4 years now. But we'll talk about the commodities here in a slide to come. Energy prices, you know, a lot of folks talk about the U.S. and the U.S.'s expanded production of oil because of fracking. Growth since 2013, the U.S. is up almost 20%. That's a big number. But when you look at globally where we're at, the global production of oil is up 5.5%. The consumption of oil is up 4%. So in 2015, we're looking at 2.1 million barrels a day more in inventory than we were. Prices come down. You know, we're at below 47 actually as of today, and the market adjusts. How does the market adjust? The market adjusts. This is U.S. crude rig count here on the right. You can see that rig count was increasing until about the late 2014 when oil prices dropped up from $113 a barrel very quickly down to $50 a barrel. And now the rig count is about half what it was in late 2014. So that's going to, some of this growth, some of the supply, or I should say production that was coming from the U.S. is now going to be lower. That's what a lower price will do. Markets adjust. And so that's one of the things that we see. We believe that a lot of the commodity space is taking on the chin because of some of the deflationary pressures, or I should say disinflationary pressures, and some of the emerging market slowdown. We think that could be a potential for some positive returns here in the near future. Who benefits from a lower oil? Well, most economies actually benefit from lower oil. You can see that we just picked a few here, but developed, the only country here that is an exporter of oil is Canada. The rest are all importers of oil, so lower oil prices are going to be positive for these countries. Global consumers have basically a tax break in the form of lower oil prices, lower gas prices, lower energy prices. Two economies that get really hurt: Russia, 13.8% of their GDP is exports of oil, and then Canada. And both those economies are suffering right now because of that. The other drag that we're going to start to see a little bit more, especially here in the U.S., and this is definitely a negative for earnings going forward for multinational companies, is the fact that the dollar has appreciated so dramatically. There's a good reason that the dollar has increased dramatically, and it's central banks have been doing opposite things. For 5 or 6 years, we've had central banks doing about the same thing, and now we've got the U.S. and the U.K. talking about interest rate hikes, while we have Japan and the Eurozone talking about more quantitative easing. And so you're starting to see, or you've seen it, the last 18 months, the U.S. dollar has appreciated more than 20% versus some of these other currencies. And this is a big reason why, the divergence of policy. So that's another thing we want to keep an eye on. But going forward, that strong dollar is going to end up hurting U.S. multinationals, and it's going to end up helping some of these international companies. This is just a chart. Manufacturing momentum, green is good, red is bad. So you can just get an idea of the trends here. You can see emerging markets slow down in the summer. We're starting to see a little bit better trends. And if we look at emerging markets as a whole, they're getting back, closer to 50. You look at the U.S. at 54.1. That's a very strong number. And then you look at the Eurozone. It's slowly improving, and we see that continuing, just like the U.S. did back in 2011. Valuations. This is, you want to always look at price, but you also want to look at earnings. You want to look at price to book, price to cash flow, dividend yield. We want to look at multiple metrics when we're looking at is a country or a company overvalued or undervalued. And so you can see right off the bat here, if we take this composite, which is taking these 4 metrics and assigning a composite and looking at the 10-year average here, you can see that compared to the 10-year average, the U.S. is actually overvalued. Developed international is slightly overvalued, if not fairly valued. But I'll say the same thing I did earlier, that when you have interest rates as low as they are now, you could make an argument that these elevated valuation levels are warranted. But we're not. We're just saying, okay, well, if we were to choose, we would choose international over the United States at the current time. It doesn't mean that these levels can't continue to be even more overvalued, or they could go the other way. But we would be buyers of international versus U.S., given the fact that the dividend yield is much higher and the valuation metrics are a lot more attractive internationally. When we look at emerging markets, even more attractive than the U.S. You can see emerging markets index is actually almost 2 standard deviations away from the norm. I'm sorry, almost 1 standard deviation away from the norm from where it is historically. And we're getting close to a 3% dividend yield, 2.9% in the EM index, while buying at attractive prices. EM is definitely a place that we that is attractive to us and that we like. Corporate profits, whenever we're talking about valuations, we also want to talk about earnings. And so, excuse me, in 2015, we saw some earnings declines. Most of this came from the two sources: the appreciation of the U.S. dollar and the energy sector earnings. So you can see in first quarter and second quarter, earnings from the energy sector were actually negative. And so I want to go further into this. So we pulled up this slide here, which is showing us the first quarter and showing us the earnings per share of the S&P 500 in the first quarter were $27.32. How did we get to that? Well, we had, I'm sorry, the Q1 earnings per share in 2015 were 25.81. Q1 of 2014 was 27. And so what made the earnings drop? You can clearly see we lost $3.55 a share from the energy sector. And in fact, earnings were down 5.6% year over year in the first quarter. But if we take energy out, earnings were up 8.5% on non-energy companies. So you can really see where those negative earnings really came from. And if we take those out, it paints a whole lot different picture than if we have them in. Commodities. Commodities have been the worst performing asset class of the ones that we follow for the last 4 years. This chart over here on the left tries to show kind of high level, low level, and where the current prices are. And you can see, with the exception of gold and silver, most commodities are at their very lowest range. And then if you look at the Bloomberg Commodity Index as a whole, it's right near the lowest level we've seen. So we believe that commodities are due for a pretty good run. When that happens, we have no clue. But we do believe that commodities at these levels look attractive, and we will continue to buy them in our portfolios, at reasonable levels, because they're also very volatile. So you don't want to have too much exposure to any one area. But at these levels, it's tough to buy because they've performed so poorly over the last 4 years. But at the same time, that makes them very attractive going forward. I pulled this slide in here just to show some of the dividend yields. We're at about 2.1% for the S&P 500. We're at 3%, or right around 3% for emerging markets. Developed markets, we're at 2.7. So you're getting pretty good dividend yields in some of these international areas. We like getting nice dividends and also being able to buy attractive looking stocks compared to U.S. And then if we want to add some dividend or yield to the portfolio, we can do so with adding some real estate. We can do so with adding some high yield. But you can see the real estate and the equity dividends versus the 10-year bond rates. And right now, aggressive assets look a lot more attractive than safe assets. Still a whole slew of cash, and that whole slew of cash is getting paid next to nothing. This is just an extremely high level, 66.6% of money supply as a percentage of nominal GDP. That's a very, very large number. So there's a lot of folks out there still holding on to cash and getting paid next to nothing. At some point, they're going to want to invest this cash when they do, it's going to have an impact on prices depending on where it goes. We believe a lot of that cash is waiting for some higher interest rates. So that's why we believe that it actually will be positive when the Fed starts to increase rates. So start to, especially for retirees, it's very difficult right now to build a portfolio that both is safe for a retiree and that earns a decent income. When you're starting with safe assets earning 2 or less, it's very difficult to build a portfolio around that when you really want to have a good sized fixed income portfolio for any retiree who's pulling money from their portfolio. So it is a very difficult time. This low interest rate environment has been almost a tax on retirees. But on the flip side of that, expenses haven't gone up as much either. It's kind of a double-edged sword. But that's why we really want to focus on real return versus nominal return. What are we earning after inflation? Fund flows, bonds really over the last 3 years are flat, where stocks have had a lot of inflows. Stock market has been pretty good over the last 3 years, and you see flows to it. Highest inflows here a couple of months ago, right when the market was at all-time highs. And then when we started seeing the tide change a little bit, a lot of funds left U.S. equity funds. So investors are doing what they always do. They're buying high, and they're selling when they see the markets going down, which is not the best thing. There's a lot of emotions there. We want to be careful with that. PE multiples, I talk a lot about them during this presentation. Over short periods of time, they don't mean anything. They don't mean much. Current PE multiple is 16.5. What does that tell us? Well, it basically tells us that the U.S. equity market is, let's say, a little bit overvalued, maybe fairly valued. But what does it tell us about what the subsequent one-year returns are going to be? There's no pattern here at all. There's dots everywhere. But if we say, okay, well, what's the pattern if we go out 5 years and we say, okay, we're at 16.5 PE, what are my returns the next 5 years instead of the next 1 year? And you can see a lot better positive trend here, more correlation. And so PE multiples give us an idea of what the next 5 years are going to look like. If we look at that other slide, it would show that at the current PE multiples, we would expect about an 8% return from the S&P 500 over the next 5 years if that trend holds true. Diversification and why it's important, depending on what type of goal our clients are trying to achieve. If they were to have started to invest with us in October 2007, and we have an all-equity portfolio, all domestic stocks, start with 100,000. That portfolio is going to be worth less than 50,000 at the market bottom, March 9, 2009. And it took 3 more years to get back up to October 2007 with that portfolio. So if you're taking money out of the portfolio, if you're a retiree and you have an all-equity portfolio and you're taking money out, you're doing yourself a huge disservice. Because 1, you don't have any safe assets to go to, and 2, the volatility that is in stocks, even though we haven't seen it over maybe the last 3 or 5 years, it's there, and we saw it in 2008 for sure. So depending on your goal, you really have to know your time frame and how much you should have in safe assets versus aggressive assets, and know what type of return you need to hit your goals. But on the flip side of that, if we looked at 40-60 portfolio, still hits the bottom in March 9, 2009, but it only takes about 6, 7 months, 8 months to recover back to its 2007 highs. That's because it's got 60% in very safe assets. So that's the key takeaways. You want to make sure that you're in the right portfolio for your goal. And then also one of the slides that we like to bring up here is, The average investor takes equity-like risk, but earns very low rates of return. One of the main reasons is jumping in and jumping out of the market versus just buying and making sure you have a solid portfolio, that you're rebalancing, and you're getting paid for the risk that you're taking. 2.5% for an equity type investor is not getting paid for the risk that the average investor has been taking. Having the right time frame, I'm not going to spend a lot of time here, but over a 1-year time frame, I can't tell you what equities are going to do. It's almost impossible. The best year for the S&P 500 has been up 51. The worst year down 37. But if you give me 20 years, I can give you a lot better range, a lot tighter range, and every 20-year period since 1950, the worst time frame in stocks have earned you 6%. So this slide is just showing the right time frame, making sure you have the right time frame. If you've got a 5-year time frame and you're in a 50-50 portfolio, this gray line here, well, there's never been a 5-year period of time where a 50-50 portfolio from 1950 until 2014 has lost money. The worst you've done is 1% per year over 5 years. So you just want to make sure that you have the right time frame for your portfolio, and that we also want to make sure we get high rates of return over the long run, so we can take more risk if we have that appropriate time frame. Intra-year moves, we finally saw one over 10%. It's been 3.5, 4 years, but the S&P 500 actually from peak to trough lost 12%. Year to date, this is as of October 31st, so we're a little higher than this now, but not much. We're up, let's say, 2% for the year, but intra-year we dropped 12%. That scares a lot of people away. We do a good job of expectations and telling people, hey, the portfolio is going to be variable, and we're going to see years where we are down. But there were a lot of investors calling or emailing in, that were anxious about this 12% pullback. When we have 3 or 4 years of not a lot of volatility, and you kind of get lulled to sleep, when you actually see some volatility, I'd say 12% is pretty good volatility, and it was over a very short period of time. Now, we didn't have to live through it very long because it took 1 month and we're right back up positive again. But it's still a wake-up call, and so you need to use that as, okay, am I in the right portfolio? Did I lose sleep because of that 12% pullback? Because when we're investing in aggressive assets, equities, the reason you get paid more is because there is more volatility. And over the last 3 years, we really haven't seen it, but it is there. And it's shown by this chart right here perfectly. 2005 and 2014, we've got returns going up and down here, and we've got volatility going across. And you can see that as you start with cash, low return, low risk. You move a little bit further, you get to Barclays aggregate. You get a little bit more return, and you're taking a little bit more risk. You move to the S&P 500, global equities, international. We've got a lot more risk, but we're also getting a lot more return. You go further, emerging markets, more risk, more return. And so that's usually, that will hold true. If you make these time frames even longer, you get paid for the risk that you take. We've taken a lot of risk in our commodities over the last 10 years. We haven't gotten paid for it yet. This is why this area looks a lot more attractive to us. But you can kind of see the more risk you take, the more you get paid in general. The asset allocation portfolio here. So this is the last 15 years through 2014. Even though the last 3 years, 14, 13, and 12, look at large caps here, up 16, up 32.4, up 13.7. Even with those 3 great years for the S&P 500, the last 15 years, the S&P 500 would have given you an average rate of return over those periods of time of 4.2%. If you just looked at this asset allocation portfolio, which is about a, let's call it a 65% aggressive assets, 35% safe assets, you would have outperformed that S&P 500 by 1.1%, and you would have done it with less risk. So the S&P 500 had a standard deviation of 17.2 versus the asset allocation portfolio had a standard deviation of 13.7. So although the asset allocation portfolio is flat for the year, didn't do great last year, didn't do nearly as well in 2013, if you look at the asset allocation portfolio, it's always in the middle. It's never one of the highest. It's never one of the lowest. Stays in the middle. That's why you get to reduce that risk that you take without giving up a lot of that return. So what are the investment implications? I think I've talked about commodities enough. We do like commodities at these levels. They're going to continue to be volatile in this type of environment. Hard currencies, we believe the dollar is elevated at these levels. At some point, we believe it's going to come back down. Market neutral, we prefer over fixed income. It's another low risk asset class that we can get a decent, a smaller return, but we can substitute market neutral for some of our fixed income exposure without taking any more risk. Emerging markets, we think they're a screaming buy at these levels. Things that we're not too keen on, fixed income with long duration. Domestic equities, we still like domestic equities, but if we're going to be in the equity space, we'd prefer international, especially emerging markets, to domestic. REITs and utilities, with interest rates increasing, we believe there's been a lot of people who have gone into these areas trying to seek yield. And so if we see fixed income rates go up, we believe some people might leave these areas in lieu for a safer yield. And so those are some of our stance overweights and underweights. And with that, I'm going to go ahead and open it up to questions. Nick, you want to go ahead and take it from here?
Yeah, thanks a lot, Sean. Everybody, as he mentioned there, please feel free to type your questions into the question box that's attached to the GoToWebinar toolbar. And I'll immediately start off here with the first question that we received during the presentation. Sean, do you have a feel for the non-searcher portion of the workforce, those who are unemployed but not looking? This is something you touched on kind of a little earlier in the presentation.
Yep, and it's definitely higher than it has been, but the more than 50% of this participation rate, I'm just going to get back to, you know what, I'm going to do this. More than half of this participation rate decrease is due to, there's two trends here. One is the retirement, the demographic trend that I was speaking to. The other is actually there are more people on disability right now because of some of the changes. And so you're seeing a lot of that in these numbers. As far as the people who are discouraged, they tend to be the highest when things are starting to improve. Because what happens is when things are really bad, like let's say when unemployment was up here, a lot of folks, they're not even looking for a job. When the BLS calls and says, are you looking for a job? They're like, no, I'm not looking for a job. Things are horrible. The unemployment rate comes down, you start to see a lot of these discouraged workers because they are looking for jobs and they can't find them because we're getting a little bit tighter labor market. But once again, beware of this 5.1% number. There's a lot of there's a lot of issues with that number. I would like to see this wage growth go above 2% to show us a tighter market, which is going to show a healthier jobs market. But the discouraged workers is not, it's not a large number of, I don't know the exact percentage, but I do remember seeing the information, and it was a very small number compared to the demographic change and the disability issue.
Thanks, Sean. I've got another question here. I'll kind of do my best to interpret this. Firstly, if you could give us a quick explanation of what you mean by a hard currency, and then maybe explain if there's any differences or distinctions amongst different types of currency.
So a hard currency would be one where we have a budget surplus or a very strong fiscal governmental stance. So you've got something behind the fiat currency versus the dollar, which we're not on the gold standard. We haven't been on the gold standard for a long time. It's the full faith of the U.S. government. So the U.S. dollar would not necessarily be a hard currency. The euro would be a hard currency. The Swiss franc would be a hard currency. Gold is a type of hard currency. Although I'm not super bullish on gold, I'm not super bearish on gold either. We can go back to one of the webinars that we had, a few years ago, and when gold was at $1,800 an ounce, we actually were calling for gold at $1,100 an ounce. And lo and behold, it's at $1,100 an ounce. And if you look at that last slide that I had on commodities, you can see that that's a fairly valued, I think it's this one here. No. Let me go a couple slides back here. Where's that? So 1141, we're actually a little lower than that now, but right in the middle of its historic price when we look at where it's priced in relation to inflation. And then once again, gold inflation adjusted price and gold price, they're right on top of each other, which is what we would expect. Gold and some of these hard currencies, they hold their value inflation adjusted. So hopefully that was a long-winded way of answering that question.
Okay, I've got another question here, Sean. In recent times here, we've seen lots of kind of lowered forward guidance or expectation among the financial reports that have come out. Do you have any insights with regard to any of that?
And there have been some indications of slower reports, but that was really before October. There was a lot of them that came out, and not everything really turned the way that their reports indicated. There's been a lot of positives, and that's why the stock market has come back so much, especially if you look at, just look at that China slide with the cyclical sectors. You can see the slowdown here. Oh man, I'm having a hard time navigating this thing. Sorry guys, I'll get there. So autos slowed down in the summer and picked up more recently. If we looked at where this services PMI is, it actually came in at 52, so somewhere around here in October. Construction and private residential flooring space, not looking so good here in the summer, and then boom, picked up. So a lot of these, and I could pull up the US one as well and the Europe one as well, a lot of these numbers are starting to look a lot more positive. So I'm assuming that you're talking about that, because some of the reports that did come out summer, and I mean even in September, were not as good. The September jobs numbers did not look good. You know, the Fed was worried about China really, but China has strengthened tremendously in the month of October. And just as quickly as markets can price a recession, they can go the opposite way. And so, you know, market participants are always trying to look at just one little thing, and if they see that, oh, China might be slowing a little bit, and how does that impact? And oh my gosh, we're going to have a global recession, and all of a sudden you see the S&P 500 down 12, you see emerging markets down 20 plus, you see international developed down around 10 or 12. But the more recent reports that have come out in October have actually been more positive if you look at the entirety of the reports.
Okay, here's a follow-up question kind of along the same lines. It's more specific. What's your take on the recent news out of the semiconductor industry?
Well, Qualcomm surely didn't have a good report after the bell before the bell this morning. I mean, it's a cyclical sector. You're looking at PCs and phones. Apple seems to be doing just fine, but that's something that we want to monitor because that's going to be a driver of future growth. But I don't necessarily see too much of a slowdown in the chip space, maybe in the PC space, but when you look at some of the mobile stuff, I have yet to look at Qualcomm's results or what they said, so I'm not sure the question is related to that or to what Intel had said a few weeks ago. I think it's something that we need to keep an eye on.
Okay, next question, and this may be trying to connect dots or make correlations that don't exist, but how may we expect a rising or a rate hike from a domestic standpoint to influence the pricing of the commodity markets, or is that something that, is there no correlation there, or is there a low correlation? What's your opinion?
There actually is a positive correlation. So I don't have the chart available to me, but I have it available. I just don't know where it's at. There is definitely a positive correlation as inflation and as rates rise. That is a positive trend for commodities prices. Nick, whoever asked that question, write that name down, and I'll find that chart and I'll email it to them.
Okay. All right, one last check here. I think we'll give a few more seconds here to see if we have any other last questions. But Sina, if you want to go ahead and start making your concluding comments and wish everyone well.
So I guess in conclusion, I think equities are better than fixed income at this time. I don't think that this bull market is done yet. Bull markets usually don't end at fairly valued, and that's kind of where we're at now, but their greed is out there, and when that is out there, people tend to go a little overboard, and the pendulum swings a little bit more than it needs to. But if you can't tell already, emerging markets, developed international, I think there's a lot of promise there, and we're getting paid to sit there in those areas just as much as we would if we were in some more aggressive corporate bond. So it's nice to get paid a little bit while we wait for the market to improve and for earnings to improve. I'd be patient. The environment that we're in is a low return environment compared to other environments where interest rates are a little bit higher. Interest rates being a little bit higher will be a breath of fresh air for portfolio managers, because you're just going to have a lot more to choose from and a lot less risk once interest rates actually do come up. And so that would be my conclusion here is be patient, expect lower returns while interest rates are lower, but that doesn't mean that long-term returns necessarily have to be lower than we anticipate them. And then also work with your advisor to make sure we know how those lower returns in the short run might impact whatever goal you have that that we're trying to achieve with the portfolio.
Okay, we have no more questions. Thanks everybody for attending tonight. Happy holidays to everyone, and we certainly look forward to seeing each and every one of you here in the next, before the end of the year. And if not, certainly we wish everyone a happy new year, and we will see you in the first quarter.
Take care, everyone. Good night.